All right, welcome back. Today we're going to do a video diving into what LEAP options are and how they could be a nice addition to your stock portfolio. LEAPs is something I've learned about a long time ago, but I haven't really done anything with them over the last 5 years. And last year I really started to just paper trade them and take a look. As I've been building out my stock portfolio, I didn't have any capital that I wanted to allocate towards LEAPs. But at the beginning of this year, I decided to dive in and buy my first batch of LEAP calls, and we're going to go over how that's going, and hopefully you guys can understand a little bit more about this and then see if it fits in your portfolio. So first off, what is a LEAP? Basically, a LEAP is a call option with an expiration that is more than 1 year out. So it gives you stock-like exposure, but with less capital up front. There's a defined downside and there is leverage without using margin. So why do I use LEAPs? For those points we just mentioned. It's more exposure, less capital, you get control of 100 shares, but at a fraction of the cost, and you do get a lot of leverage without margin, and it is a long-term time horizon play because you're buying 1 year plus out. So this is kind of a bridge between investing and trading. It's conviction based, it's not just a lottery ticket. So when we talk about options, I don't typically buy short-term options. I may do a swing trade or a hedge, something that's 30 to 100 days out, but I never buy anything shorter than 30 days. I typically sell options that are under 100 days. I'll sell covered calls or I'll sell cash secured puts, but I typically don't buy options unless they are longer term. It hasn't worked for me in the past. You have to be right on the time, the price, and the volatility. So there's too many factors there. I'd rather just own the shares or sell a call or sell a put. So how you want to buy these LEAPs? You want to buy LEAPs that are deep in the money. So the strike is well below the current price. That's where it behaves like a stock. It's not a lottery ticket. So if you're buying, let's use Amazon as an example. Amazon's currently $220. You don't want to buy the $400 strike because that means Amazon would have to move from $200 to above $400 for you to be in the money on those LEAP options. So for an example that we'll talk about in a moment, you want to buy something that's 150 or 170, somewhere that is below the current value of the share price, so that way it's in the money. And the further down you go, the more deep in the money it is. Delta, we're not going to get too into this, but you want to have a delta, in my opinion, something over 0.7. So if you have a delta that's over 0.7, that means you're in control. One share or one contract is synthetically the same volatility of 70 shares. So to me, that was a good number to where you're not having to pay too much for the option, but you're also not paying too little and not getting the full leverage of the LEAP that you want. So for options, volatility is a big component, and you want to buy options when volatility is low. You want to sell options when volatility is high. So you don't want to overpay for volatility. Wait for the IV rank to come down, typically post earnings or in a quiet market. That's when volatility crushes, or even if a stock is going down, the calls may have a low volatility because it's not there's not a lot of volume and action going into those calls. And you want to do this in quality names. You don't want to buy, a penny stock LEAP. You could do it, but it's just you want to buy blue chip names, quality names, things that people know, so there's more liquidity. And then you just want to avoid things that'll just plummet 50% because your options will quickly get erased. So deep in the money, it acts more like a stock. There's less theta decay. You're paying for time value and you're paying for the intrinsic value. If the stock just sits, you don't bleed out. So options, as they get closer to the strike price, the value of the contract gets less and less and less. So you want to make sure you're buying deep in the money so that way you don't get theta decay, meaning your option just slowly dwindles down. Delta, we're not going to go too deep into that. The Greeks for options are very complicated, so we're going to keep this short and sweet. And the low volatility environment, we kind of already went over that. Quality names make sense. So when you're buying a LEAP contract, you have the ability to either sell the contract for a gain or exercise to purchase 100 shares. So a quick example down here, I did buy that $150 leap on Amazon. I paid $6,700 for that 150 leap. So I have, because I hold the contract, I had the ability to say at any time throughout the contract's life that I held it, I could say I want to buy the 100 shares of Amazon at $150. So I would have to put up an additional $15,000 to purchase Amazon shares at $150. That's on top of the $6,700 that I paid for the premium. So that would mean I'd be buying Amazon shares for a total of $21,700. The current, so basically my cost basis for Amazon would be $217. Now Amazon is currently $250 per share, so I'd still be making a nice gain on that if I were to exercise, or I could just look to sell the contract for the appreciated value that I get. So you have options here. Literally, that's why they're called options. If you buy the option, you are the one that dictates if you want to exercise or not exercise. So this is where you're blending in the trader and the investor, because if you wanted to pick up more Amazon shares, you have the ability to buy at the strike price that you selected, or if you want to just sell the contract, that is a trade. You're buying the contract and selling it for an appreciation. You never touch the shares. So this stuff can get complicated quickly, but this is the beauty of buying leaps. And ironically enough, what really got me to really look into this is following Nancy Pelosi's trades. She would buy so deep in the money call options on Google, Nvidia, Amazon, and to see her gains on those, it was eye-boggling. And she would also exercise to build her stock position. So I thought that was a very savvy and a very interesting way for her to take advantage of buying stocks, is by buying the options. Now, with the information she has, she does very well for herself. But on top of that, she uses the leverage of options to either sell some of the shares or just sell some of the options, or execute those and get shares at a very cheap price. She had some options not that long ago for Amazon at like $50 strike. She was buying these $50 leaps, and then Amazon was $200, and she was exercising half of her options and then selling the rest. So she made a killing on that, and she then had a cost basis of Amazon shares at $50. So that made a lot of sense. So this was an example of one of the calls that I purchased this year. So I did buy that 150 call for January 2026. This is on top of buying shares. I bought another leap on Amazon, so I have a ton of Amazon exposure, and we got a huge run up on Amazon. So I wanted to go ahead and take one leap off the table. And so what I did is I bought the initial leap for $6,700 and I sold it for $10,649. So that's a 60% return in just under a couple of months. So I still have another leap, and I obviously still have my Amazon stock position. I could have held this for longer, but I wanted to take some chips off the table because we have Amazon earnings coming up next week, and that's a binary event. Could move the stock up 20% or down 20%, and if it goes down 20%, I would feel more upset that I didn't take one of these leaps off the table, versus if it goes up 20%, I wouldn't have, I'm not going to be kicking myself because I took some profits on a leap, because I still have another leap plus all my shares. So that's the trader in me, paying the trader, taking some chips off the table. And that's what's nice about these options contracts, because I'll never sell my shares. The point of buying shares is to accumulate for retirement, but these options, you get to decide, hey, do I want to sweeten the pot, take some profits off here? Do I want to let it ride and live with the result? So this is my current leaps portfolio that I have right now. I still have a 220 leap, January 2027. That cost basis was $4,000. I bought this at a terrible time. I bought this at the very beginning of the year, and then Amazon dropped 20%, and now it's rallied 25%. So I'm finally in the money slightly on this leap, but I've watched this leap go through a whole roller coaster here. Uber, same boat as well. I have the 60 call, so this one is much deeper in the money than this 220 Amazon leap. Mistake on this is I should have bought the 150 as well, but I bought this. This was the first leap that I bought, and it's not as deep in the money as I should have gone. And then IBIT. So I bought some IBIT 40 calls. Same mistake here as this 220 Amazon leap. Should have gone even deeper in the money. I'm down 30% on these leaps. They were down 50% a few weeks ago, but with Bitcoin creeping up a little bit, these are potentially going to get back to break even. Or I may lose my total investment here if Bitcoin doesn't make a move within the next 300 days. And this Amazon 150 leap, this was the one that I closed for the profit. All right, so the risks for leaps. Volatility can cut you both ways. It's a leveraged position, losses are fast, and the gains are amplified. So if you buy close to the money and the stock goes down, you're going to lose some of your value. But because you have more than a year for these leaps to play out, you're hoping that it can bounce back. And given the market has an upward trend, you're likely to see at least a revisit of your cost basis if you go deep enough in the money. Also, you can lose 100% of the premium you put in. So for example, these leaps here, if these stocks don't make another 5-10% move, especially IBIT, I could see the complete loss of my capital that I put in by the end of this year. And that's a risk I was willing to take. Position sizing is everything. Leaps should be a slice, not the foundation of your portfolio. So for these positions here, Amazon's my second largest position. IBIT, I have a lot of IBIT. So instead of buying more shares of IBIT, I wanted to buy some leaps. Uber, I don't have a huge stock position in, so I will probably look, instead of buying more leaps in Uber, I'm going to start adding shares within these next couple of months to Uber because I want to build that position up rather than buying some leaps. And this is not a replacement for your core holdings. So just like we said with position sizing, this is not a replacement. This is a slice. This is a sweetener. This is the sprinkles on top of the cake. So this is just when you get a nice market rip, to look at your leaps is a lot more fun. But it's only fun if you've got the share position as well to give you that optionality of either adding to your share position or, if the market pulls back, at least you have your shares. You could lose your leaps if you run out of time. So I hope this video helps you guys. We'll do a video diving deep into covered calls. That is my bread and butter strategy. When it comes to selling options or using options, that is the bread and butter, is selling the covered call. So I will come out with a video within the next week or so on that. Until then, everyone have a great weekend, and I will see you next week. Peace out.